Hello, everyone. I'm Lynn. This is Jose. I know we're both very pleased to be here this morning. Anthony said that everyone is here for different reasons, and I hope we get this conference kicked off with one reason that I know is on Anthony's mind, and I hope it's on all of your minds, which is, what can we learn here today about how to make our investments better and our society better? What we know is that we live in the greatest country that has given us all the greatest opportunities. But sadly, it's off the rail for a lot of people. 60% of Americans don't think this country is working for them. That's not a good look. I am often reminded of a line in The Leopard where the courtiers to the Italian royal family, concerned that their world was falling apart, the courtier said, "If you want things to stay as they are, things will have to change." And right now, 1% of our country controls 42% of its wealth, while 80% of our country has 4.7%. Half of Americans cannot put together $500 in an emergency. That is probably not sustainable. Whether it is talk for the first time in my lifetime, and Anthony doesn't talk about his age, but I'm 65 this year, so I'm 65 and proud of it. So I've lived the American dream, and I'm really worried about where we're going. And if we think that we can continue, with this situation, I think we will be proven wrong. Whether it's talk about socialism or divisive populism, none of it is good. But the good news is that the power of markets is extraordinary, and the power of markets can make the world a better place and make all of us richer. I am really pleased to be interviewing Jose, who I'm going to let him describe his firm, but when I think of the way capitalism should work, I think of it as inclusive capitalism, sustainable, inclusive, strong, dynamic, and trusted. And your company, TIAA, was started by none other than Andrew Carnegie, who cared an awful lot about how wealth was distributed, and he didn't do too badly as an investor. So maybe, Jose, you could talk about Nuveen and your philosophy of investing for better results and a better society.
Sure, and we do have a long history. As you mentioned, our parent company, TIAA, was founded back in 1918 by Andrew Carnegie to provide retirement needs and services for people generally in the academic or universities, colleges in the US. Nuveen is the investment arm or the asset manager for TIAA. We manage approximately $1 trillion. About 60+% of that is on behalf of TIAA. The rest is on behalf of institutions and retail channels across the board. Very global business. I think we're unique in that around, of that trillion, a little over 200 billion is in the alternative space. And the three pillars that we differentiate ourselves, one is across income solutions, because we have, again, over a 100-year history of providing retirement services and yield solutions. Alternatives, because we have the scale and leadership. And responsible investing is our third pillar that we really focus on. We have over 5 decades of experience and leadership in the space, going back to the 1970s, where there was more engagement around apartheid and the issues then. And what I would tell you is that today, the dialogue has changed dramatically, right? What was more of a dialogue of creating exclusion or providing products and innovation so that if individuals wanted to invest in the space and not own particular sectors or stocks, that we had the ability to provide them with those opportunities. And today we have north of 20 billion in AUM and those types of products. But what we're seeing today is that the dialogue has shifted to one more of if you look at the millennials today, they are looking to invest in companies and invest with managers that share their own values. We recently had a survey that showed high net worth participants, over 52% of them suggested that they would be willing to put their entire portfolios in a more responsible investing type of strategy. Amazingly, when you look at millennials, it was over 90% had that view. And today, when just about every request for information we get, or RFP, there's discussions around what are we doing around these factors, around ESG, responsible investing. So that dialogue that was more around what are you excluding is more around I'm not willing to pay a higher fee, I'm not willing to get a lower return, and a belief that investing in these factors drives to a better outcome, not just for society and the world as a whole, but our portfolios. And I think we're spending a lot of time, intellectual property, data, bringing transparency and being able to show that by putting this forward, it is about the bottom line. It's about driving long-term returns and bringing out alpha. I'll give you an example, some of our early work that uses these factors, and I think over almost 80% of our AUM now is using some form of an ESG factor in the investment process. Again, not a constraint, but more of a risk factor. You have companies like PG&E that, in these portfolios that use these factors were like underweight or had no holdings. And we saw what happened there from an ESG perspective with the California fires. Might have been Volkswagen from a corporate governance. So more and more, we're seeing that the data is pointing to understanding this from a risk factor perspective is going to drive your bottom line and your long-term returns.
So we know that there's $12 trillion invested in responsible ESG inclusive investing. But my question is, so that's about a quarter of institutionally invested. Shouldn't all investments be run according to finding the companies that are the best companies for people, for product, for planet, and not make this an ESG silo, but ideally make it across the board so that all companies have a race to the top, not only their profitability, but their value creation caused by the positive impacts of how they treat their employees, the positive impacts of taking care of their supply chain for the long term, positive impacts of keeping the planet and their communities solid. Do you see that eventuality?
Yeah, it's where we are in the J-curve, and we're seeing that really accelerating. Like I said earlier on, it was around exclusion and investing in, we have ESG ETFs, we have a social bond fund. Again, there is a criteria around that. More and more, the discussion is more broadly around how are you incorporating this across everything you do. I mean, we may get requests for information on a money market fund, and questions will come in on the ESG side. And the reality is where we are, it's about providing now that data and information. Like, as you said earlier, the markets are a pretty strong factor, major factor out there. And we're seeing it from our clients. The discussions are happening across the board. So like many other sectors, whether it was when we first started investing in real estate, right? There's so much more information today. You're seeing the dialogue coming from the demand side around pushing how do we get better intellectual property, better data that basically says this should just be another common factor to our investing. And I know at Nuveen, our goal is to get 100% of our portfolio managers incorporating this into their investment process. To do that, though, we have to spend money in the infrastructure, in the data, bringing in data scientists to bring out that transparency so that the market knows these are important things to drive the bottom line.
Right. And I have found that the biggest impediment to investing along the lines of who is best for their people, their product, their planet, is how difficult it is to analyze companies. That there's a lot of data out there, but none of it is disclosed really in a comparable, assurable way. Contrast that to financial information. So James McIntosh had a very interesting column where he said, in one case of of ESG analysis, Tesla comes out as the best. That's by MSCI, because they look at the Tesla product, it has a low carbon footprint, so it's high. The FTSE Russell Sustainability Index looks at how dirty their plants are and how badly they treat their workers and puts them way down. So if you just choose a broad index or a stock based on some rating, the ratings aren't really apples to apples. And Nuveen was involved with us in the creation of the embankment project.
Epic, right.
Epic. And we were trying to solve that so that you can say Coke is better or Pepsi is better with water than Coke, and we know that. But you don't really know that for sure based on the glossies. Do you think we can ever get to some point where we will be able to measure some of these things that matter?
I absolutely think we will, and it's the evolution that we're headed towards today, right? Epic is a great example of trying to take on the leadership of driving those metrics, driving the transparency, and bringing that out to the broader market so they understand the correlations of these issues relative to, again, their bottom line or ultimate returns. You know, for us, a lot of it, and we've done this in other asset classes, we were the founding members of principles around investing in agriculture. We've taken a lead position on the real estate side with lowering carbon footprints. A lot of this is because we know this is the right thing for our portfolios, it's the right thing for our clients, but it now takes investing the dollars, the resources, and the energy to bring to light that information and bring that data so that our portfolio managers today can go on their desktop and readily available, they have this information. I mean, you mentioned the different indexes. We're probably the largest owner and manager of green bonds, but we've also have taken time to educate our clients and take a different view and different perspective as to, well, what really categorizes a green bond and how broadly can you look and what's the good, what's the bad. Again, it's not a commercialized area today, but you're quickly seeing that, and it's coming from the best place. It's coming from watching what's happening with real returns, and it's coming from our clients who are demanding this today.
Yeah, absolutely. Maybe I should explain what EPIC is. You and I worked on it, but the Coalition for Inclusive Capitalism and EY led an effort with $32 trillion of assets under management, all committed to at the CEO level by the world's largest asset owners, so CalPERS and CalSTRS and GPIF, the largest asset managers, Nuveen, BlackRock, Vanguard, three of the largest companies in 3 sectors. And then the approach was for it to be totally confidential for the corporates to describe what they believe with respect to their workforce is a real long-term value creator. What they believe with respect to their community, with respect to their innovation, are all long-term value creators. And then sit with the asset managers and the asset owners to decide if those factors are actually something that they would want to invest in. Would they want these companies to produce a comparable, assurable number? And in the case of talent, as you know, we started with 400 different factors, from engagement to diversity, and ended up with 5 that they agreed on. And on March 28th, the Investor Advisor Committee at the SEC recommended that those factors be mandatory, that companies have to reveal them so that we as investors are able to compare in the same way that we compare financial results. And I know the House Financial Services Committee is taking up a bill this month also about that. So from the investor level and from the corporate level, I think we should get ready for this kind of disclosure to be required. Because one thing you said about you is that you're investing resources in finding this data. But of course, if it were disclosed, it would be cheaper for you.
And that's the key, and that's where this is where it's accelerating in terms of the ability to bring more of this transparency. And then, for us, again, it's not about exclusion; it's more about engagement, right? So, as a firm, we voted over 14,000 proxies. We can track that we've had over 600 meetings with our investment teams together with management and the companies that we invest in, to have this dialogue, to better inform them, here's the information we're seeing, here's how you could be more efficient, here's how you could be more innovative and partner, because again, we're the capital that's here for the long term, but we all need to invest in this information so that it's not just doing this because it's the right thing to do, it's doing this because it just makes sense from an operating model.
Yeah, absolutely. Oxford produced a study where what they did was they looked at 2,200 academic studies that tried to make the correlation, because of course, causation is impossible, but the correlation between companies that do the right thing by their people and their planet, their communities, their product, and long-term stock performance. And vast majority of those studies prove lower cost of capital, better return on assets, better return on equity, and better long-term results.
And I think we've had an advantage of having this long history on the real asset side, because this has always been part of the analysis, right? It's pretty simple. If you own billions of dollars on the coastline, rising water levels are going to matter to your portfolio. If you own farmland globally and the productivity of that land goes down, it's going to directly impact your portfolio. So we've had to introduce macro policies, principles for the necessity of how are we going to invest in this asset class for the long term. We're trying to take a lot of that same philosophy now and say, just because the market is liquid and you get out, we're still long-term driven, and these are now really coming to the forefront. And it's real time, right? Because like I said, you look at PG&E, you look at Facebook, you look at Volkswagen, these are real-time issues that you're seeing impact people's portfolios today.
Yeah. And I started by talking about where we are as a society, and what your investing philosophy proves and is that you don't have to choose between what is right for your portfolio performance and what is right for the society at large. And when you have Larry Fink requiring companies to explain to BlackRock what their purpose is in society, boardrooms are taking all of this very seriously. And so it's a virtuous circle if we look at this as a race to the top, as a race for the best companies to be, and therefore the most valuable, to be defined by how they treat their employees and their planets and their communities.
And simply when you look at the demographics, again, when you look at the millennials, just who the next generation consumer market's going to be, investors are going to be, these are all issues that they deeply, deeply care about.
Exactly, and they're going to inherit $30 trillion and they'll be 75% of the global workforce by 2025. So the way they see the world is really important. I went to a town hall that an insurance company held, and a 30-year-old woman stood up and she said to her boss, basically, she said, I want you to invest my money in companies that are creating the kind of world I want to retire into. And that's whose money we're
By the way, there's diversity again that's important as part of this, right? Because you mentioned the wealth that's going to be inherited. A significant amount of that population is female as well, which is why it's also been important around diversity at the board level, et cetera. These are all, again, bottom line issues.
Exactly. Well, I'm all for diversity. That is for sure. Well, they say that what happens in Vegas stays in Vegas. And actually, my hope is that everything that you hear the next 2 days does not stay in Vegas, that you all take it out and that it becomes a part of the way we think about our investors. Every CEO I know knows that his or her workforce, his or her community reputation, his or her innovative products are what creates a great company. And they're driving toward that. And to the extent the capital markets drive toward companies that do that for the long term, I really believe it's going to seep out into society.
Just about everybody in this room has stakeholders, and the reality is more and more you're going to hear more around responsible investing, ESG issues from your stakeholders, regardless what part of the value chain you're in the financial services area.
Thank you,
Great.
Jose.
No, thank you.
Thank you.